As mentioned earlier, we identified that currencies are traded in pairs. However, many of these pairs are actually derivatives from another pair. For example, the pound yen, which is the British pound and Japanese yen, is a derivative for the pairs pound dollar, dollar yen. Therefore, the relationship between the movements of these pairs are somewhat related to one or both of the pairs. Furthermore, there is also numerous other factors which cause positive or negative relationships between movements of currency pairs. Correlation exists for a number of reasons. Some of them include that many countries are trade partners with each other, which means that the economy of one country is highly dependent on another country. For example, Australia is very gold resourceful and produces much gold and exports the majority of the gold through to the United States, which then exports it worldwide. Hence, the economic growth of Australia is directly related to the export of gold by the USA. Another example is China and the United States. China is very service resourceful and accounts for the majority of the production through to the United States. If the demand for certain products is low, it will mean that China will produce less goods, and as a result the economy will slow down accordingly and affect the currency value. Another reason is that some currency pairs contain the same currency in the base pair as the other contains in their cross pair. For example, the euro-dollar and the dollar-Swissy. Since the Swiss economy is based in Europe and tends to mirror the European economy in general, and because the US dollar is on the opposite side of each of these pairs, their movements to an extent will mirror each other. Correlation is explained as the measurement of the relationship between two instruments. The correlation coefficient, which measures the relationship, is defined as a value of +1 ranging to -1. However, these values are extended to +100 and -100, to which are easier to understand. A correlation coefficient of +1 means that the two pairs move in exactly the same direction as each other. Correlation of -1 means that the pairs move in exactly the opposite direction of each other. Correlation coefficient of 0.26 would mean that the two pairs have a slightly positive correlation, and a correlation of -0.6 would mean that the two pairs have a slightly negative correlation with each other. So when one pair goes up, the other pair will go down. A correlation of 0 means that the pair moves independently of each other. They have no relationship at all. It's important to remember that a correlation coefficient tells us that the pairs move in the same direction. A value of a positive amount does not mean that they move up, and a value of a negative does not mean that the pairs move down. For example, a correlation coefficient of 100 between pairs, such as the pound yen and euro yen, does not mean that both of the pairs will increase in value. It means that these two pairs move in the same direction. Hence, when the pound yen increases and the euro yen increases, and when the pound yen decreases, then the euro yen decreases. Correlation identifies the direction of the pairs up or down. Positive correlation means that two currency pairs move in the same direction. If one currency pairs move up, so does the other. To illustrate this, let's take the example of the euro-dollar and Aussie dollar. The euro-dollar is made up of the euro and the US dollar. If the price of the euro-US dollar increases, this can mean that either the euro is in more demand or the dollar is in less demand. Either scenario will result in the price of the euro increasing against the dollar. An example of a positive correlation: if there is more demand for the dollar, then there will also be more demand for the dollar against other currency pairs, because there will be more demand for the dollar overall. If there's less demand for the US dollar, then there will also be less demand for the US dollar against other currency pairs, because there will be less demand for the US dollar overall. Negative correlation means that two currencies move in the opposite direction to each other. If one currency pair moves up, the other moves down. To illustrate this, let's use another example, this time the euro-dollar and dollar-yen. An example of negative correlation: if the demand for the dollar decreases, then the euro-dollar will increase, whereas the dollar-yen will decrease. If the demand for the dollar decreases, then the price of the euro-dollar will increase, whereas the US dollar-yen will decrease. This is because the price of the dollar is denoted differently for these two currency pairs. The US dollar weakness will be shown as an increasing price for the euro dollar and seen as a decrease in price for the dollar yen. Let's have a look at trying to understand the correlation tables. The column across the top is our currency pair, and the column on the left is also a currency pair. We are looking at the relationship between these two pairs. Looking at the table, we can see that we have Aussie Canadian and Aussie Yen showing as a value of 24%. This means that there is a slight positive correlation between these two pairs, but not high at all. In the next example, we have the Aussie Swissy and Aussie Kiwi showing us a value of 88.5. This is telling us that these two pairs move in the same positive direction to each other. Basically, when Aussie Swissy goes up, so does Aussie Kiwi. And when Aussie Swissy goes down, so does Aussie Kiwi. They are positively correlated and hence moving in the same direction to each other. By contrast, the Aussie Swissy, Euro Aussie, shows a negative value of 95.9. This is telling us that when the Aussie Swissy goes up, it means that the Euro Aussie goes down. They are moving in opposite directions to each other. It is important to remember that correlations do change and vary based on the time frames that you are analyzing, so therefore one needs to take this into account when we are making our trading decisions. We also use correlation to enable us to do reanalysis of trades which are currently running, which will be explained in the strategy section. Currency correlation is important for a number of reasons and can be used to manage exposure of your overall account, and can also be used for confirmation of trends, thereby ensuring that all trades which you enter are always high probability. A common mistake that novice traders make is by not understanding how correlation in currency pairs works regarding their exposure. Correlating trades can cancel each other out. For example, if you open up a buy order on the euro dollar and a sell order on the pound dollar, then it is likely that any profit made on one trade would be offset by the loss on the other side. If a trader opens up a long position on the euro dollar and a short position on the pound dollar, then because they are likely to move in the same direction, one will produce a profit and the other will produce a loss. Any profit made on the one trade would be offset by the loss of the other. Opening up opposite positions on a strongly correlated currency pair is counterproductive. If a trader opens up the same position on a negatively correlating pair, such as the euro dollar and dollar yen, then if one position results in a profit, the other will result in a loss. Opening up opposite positions on a strongly correlated currency pair is counterproductive. Therefore, opening up on opposite positions, i.e. a buy and a sell or a sell and a buy, on positively correlated pairs will result in counterproductive positions as well. Opening up the same positions, a buy-buy and a sell-sell, on negatively correlated pairs is also counterproductive. Correlation can be used for diversification. Since certain pairs are not 100% correlated with each other, you can use correlation to diversify your risk. Let's say that you assume that the US dollar will increase. Instead of opening up one position of two lots on the euro dollar, you can split the position into another pair, such as the Australian dollar US dollar. This way, you are increasing your probability and diversifying, as you are not exposing yourself to the movement of one country. You've added a third country into the equation. As a result, these countries' monetary policies are different to each other. Bear in mind that different currency pairs move in different pip values to each other as well, and this is something that you can take advantage of. Let's look at the pairs euro dollar and dollar Swissy, which have very high negative correlation to each other. Euro dollar moves in smaller pip values to a pair like the dollar Swissy, and a move in opposite directions to each other. You can use this to hedge your positions and minimize or even end up in profit on trades. Let's assume you are in a buy order on the euro dollar, and you have opened a position of one lot, which has currently moved against you by 5 pips. By opening a buy order on the dollar Swissy, you can hedge this trade and still end up in profit if your trade on this pair now moves in your favor by 6 pips. Since the movement is different for your pairs, this can still end up in a profitable position or minimize your losses. Correlation is also used to confirm trends. If we know that pairs move in correlation with each other, and we are obtaining the same trend confirmation on these different pairs, then we are able to acknowledge that this is a higher probability trade. If we know that two pairs are highly correlated, and we come to our analysis and see that the same signals have not been given on the two different pairs, then we know that this trade is not a higher probability trade, as we understand that we had to have missed something fundamental which affected one of the pairs. If we know that the same signals are being given on highly correlated pairs, or that the opposite signal has been given on inversely correlated pairs, then we know that this trade has a higher probability. By understanding and utilizing this, we are using the correlation to find out which pairs move in which direction with each other, and then making sure that our analysis is being confirmed when we are entering into trades. As a result, we are not looking at one pair and then making a trading decision, but we are looking at multiple pairs to make sure that the same signals are being confirmed by highly correlated pairs. This ensures that when we enter trades, the probability of this trade being successful is higher. Correlation can also be used to keep you out of bad trades, such as a false breakout. If you're observing a currency pair that has been in a range and you observe a breakout to the upside, you can use positively correlating pairs to see if they have also broken to the upside. Let's look at another example using the euro dollar, Aussie dollar, pound dollar. All of these pairs are positively correlated with each other and hence should move in the same direction. In the following chart, you can see that the euro dollar has been trading in a range and broke to the upside, which has been marked by number 1. At the same time, the Aussie US dollar is moving in the opposite direction, which is marked by number 2. The pound dollar is also not breaking to the upside, which is marked as number 3. You can see that even though there is a breakout on the euro dollar, there is no confirming movement on the Aussie dollar or the pound dollar. You can also see that after a very short time, the euro dollar then fell. As a result, there's something fundamentally going on in Europe, which is causing this false breakout.